Hello and welcome to Trading 5 Talents. In today's video, I am going to be giving my final opinion on the weekly options list service for their covered calls. Now, I've already done this with their cash secured put list, and so those videos are on my channel. But if you've been following, I've been doing this also for the covered calls list for the past 5 weeks. So this is the week 5 review, and then I'll go ahead and give my final verdict for this service. So let's take a look at what happened this past week. All right, for the week of 4/25, that was this past Monday, there were 10 calls that were suggested using my filters on the weeklyoptionslist.com. The link is down in the description. And what this is a subscription-based service for the wheel strategy. So it gives you weekly plays for cash secured puts or covered calls. The covered calls is a new service that they just started, again, about 5 weeks ago. So that's why I've been doing this review. So $5,000 limit, greater than $25 premium, greater than 2% ROI, and no earnings. I'm also not trading any volatility products or leveraged products, and I'm only choosing the first recommended strike price for each ticker. So first one, BBBY. $20 strike price, but it opened at 1682. So there's a good distance from the covered call strike price and the opening. So all of these are out of the money covered calls. Sometimes when this screen runs, and it runs on a weekend, when you open up on Monday, you're actually selling an in the money covered call. And again, those can still be profitable, but all of these, because of big gap down over the weekend, they all are out of the money covered calls. So how did this work out over the week? So you can see that there's a mix of assignments and no assignments. So what you're looking at here are the stock prices, stock closing prices each day, and then the option prices each day, final ROI, sparkline summary, and then whether it was assigned or not. I'm not going to go through each one. I just want to highlight a few of them. What I really want to look at are the ones that were assigned. So let me hide these right here just so we can see everything in one view. So GPS, I guess that one was pretty good. BILI was pretty good. This one down here is the one I want to get into. So this is PDD. So let's hide everything else so we can see just PDD. Last Friday, this stock closed at 34.73. On Monday, it opened down 33.41. And if you would have purchased this, if you were using this particular trade, you would have purchased the shares at $33.41 each, and then you would have sold the covered call at $39. So again, there's a good distance between the purchase price and then the covered call price. You can see by Friday, it closed at 43.23. So this really shot up. This expired in the money. You received 39 cents for it, and the final ROI was 1.2%, which was calculated by taking the premium received divided by the amount of money that you used to purchase 100 shares. So yes, this covered call would have been assigned, but here's where the covered calls really have a lot of power. So if you purchased the shares at $33.41, but you had to sell them at your covered call strike price, which was $39. So 39 minus the 33.41. This is $5.59 you would have earned per share. So that's $559. But you also had the premium of 39 cents. So you would have made $598 from this play right here. $598, 39 cents from the credit you received by selling the call, and then the rest of it coming from the stock appreciation. Buying at $33.41, selling at $39 by the end of the week. This would have been a really profitable play. So what would the final ROI be if you were to take everything into account? Well, it's that it's that $598 in profit divided by how much you spent, $33.41 per share. So that would have been, 17.9% ROI, which obviously is a really good ROI just for 1 week. This would all happened in 1 week. So this would have been a great play if you would have entered into it. Now, again, what happens if you just would have bought and sold the shares? So it would have been the 43.23 closing price minus what you purchased, 33.41. You would have made $982 if you would have bought Monday morning and sold at close on Friday. So you would have made almost $1,000 And again, if you were to, time the market perfectly with this particular ticker, then yes, you would have made a lot more just by buying and holding. But the beauty of selling covered calls is you don't necessarily have to be completely right to be profitable. If the stock went down, you still would have kept your $39. If the stock went up, then you could have kept your $39 and just sold your shares the following Monday for a profit on the stock appreciation, or you could have sold another covered call. So for what it's worth, this was a good play either way. But again, to take the max profit in 1 week of $982, you would have had to time it pretty accurately to do that. And obviously we know that is very difficult to do as a trader. All right, so that was PDD. KWeb did something similar. You bought at 24.40. It was assigned because it went up to 28.42, but you would have made about $200 just in the stock appreciation. So 24.40 up to 26.50 plus the 55 cents in credit. So that would have been a really good trade as well. Now, overall, this week did really well. So let's take a look at all 5 weeks in summary. So the win rate for the past 5 weeks, week 1, 90%, week 2, 90%, week 3, 80%, week 4, 80%, and week 5, 60%. What I'm defining as a winner here is based on the definition that the developer of the site gave, and that was if your shares are not called away. That is, if you were able to keep your shares and let the covered call expire worthless, then that would be deemed a winner. So that's what these numbers are representing. So you would have been able to keep most of these shares. Now in a red market like we've had the past 5 weeks or the past 2 months, I guess 3 months, then when you sell covered calls, stocks are going down, you're keeping your premium and you're also keeping your shares. But in many cases, you're probably bag holding a lot of shares as well. So there's a video that I put out several months ago of what to do when your stock is crashing and when you're bag holding. There are a list of a few ideas of what you might be able to do to get back to your break even a little bit quicker. So I'll put the link at the top and you'll be able to check that out if you would like to. So for the total of the past 5 weeks, 40 out of 50, so that's an 80% win rate. And that's, again, what he is representing on his website, approximately 70-75% win rate for both puts and calls. And again, when I tested it, it hits exactly there, maybe even a little bit better. So overall, really good win rate. So here are the filters that I found that work for me the best. That is $5,000 limit. Of course, you can adjust that according to your trading amount. Greater than $25 premium, greater than 2% ROI, no earnings, and also no volatility products. For me, no leverage products. And then again, I'm just choosing the first strike of that ticker because many times if it's a really good play, there'll be multiple strike prices that you can choose for one ticker. I'm always choosing the first one. The reason I'm choosing the first one is because according to the developer, this algorithm called the Evolve algorithm ranks them in terms of ROI and profitability. So the higher ranked suggestions are actually more profitable. So that's why I'm choosing the first one. So would I recommend the covered call list from the weeklyoptionslist.com? And that is yes. So sometime on Saturday, check it. You can also check it on Sunday if you want. Make a watch list using all of your filters. You can use mine if you want. You've seen how they performed over the past 5 weeks, but I'll always do your own research and choose the filters that best suit your risk tolerance and your trading style. And then you enter the trades on Monday morning that fit your criteria. Now remember, because these suggestions are based on Friday close prices, things will change by Monday morning. They will gap up, they will gap down. So there'll be some news or some event that happens over the weekend that no one could have predicted. So just watch out for those gap up and gap downs because that's going to affect obviously not only the stock price but also the options priced. So that's why it's good to have a list of these trades that you could potentially enter for the week, and then when you look at those live prices on Monday morning, then based off that list, then you enter a trade that still fits the criteria that you want to trade with. The other thing I wanted to mention, because this is what I generally do for all my trades, is I exit for a profit. Now, the way that the algorithm is set up, or at least I guess the way the strategy is presented using this Evolve algorithm, is that you just simply let your options expire, whether it's a cash secured put or a covered call, and you gain 100% of the premium. I usually like to exit anywhere from 50 to 90% based on, conditions or, whatever risk tolerance or, good prices for the next expiration. But I'm exiting early so I can lock in the profit. I take that risk off the table, and then I'm able to use that collateral, which could be shares for covered calls or cash for a cash secured put. And then I can enter another trade for the following expiration or the following week. Thereby, I'm taking advantage of more theta decay. However, as you saw in the PDD example, sometimes being assigned can net a lot more profit. So you wouldn't, exit early. Again, it's up to you. It depends on whether or not you want to keep the shares or you don't mind the shares being called away. How much profit is still available? Is it better to just ride it out until expiration or to exit early? It's completely up to you, but I found that for me, most of the times I'm exiting early. So let's take a look at the progress over the week so you can see what might have been a viable option for you if you would have taken these trades. So let me unhide these here. You can see at least right here. So you entered which one was this? This was NNOX. You entered the trade at $11.40 per share, selling the 12.50 call. So you can see it goes down to 10.84, and you gain 35 cents premium. So it went down to 10.84 Monday, 11.34 by Tuesday, and it goes down to $11 by Wednesday. Now at this point, what you could have done, because the option was down at a penny already, you could have exited on Wednesday. And now you could have lowered your call strike price if you wanted to. So instead of selling another 12.50 call when you purchased them at 11.40, if you wanted to, you could have sold an 11.50 call on Wednesday for the following week, or maybe even the same week, and you would have been able to get 2 trades in 1 week, thereby netting you a lot more profit for that week. So that's what I mean by exiting early. So if you just would have left this on the table, what's the advantage, at least the way that I see it, what's the advantage of keeping this option open, for $1? You're not gaining anymore. It's already achieved pretty much its max profit or just under its max profit. 99% of the profit was already accounted for in the first 3 days of the week. So I would have exited early on this trade. Similarly for this one down here, which one was this? So this was BBBY. You entered at 16.82. Look, by Wednesday, it was down to 4 cents. You sold it for 42 cents. So 90% of the premium is already made. If you just would have bought to close at 4 cents, you would have kept, $38 out of 42. So that extra $4, it didn't really do you that much because it went down to 13.71. At least you wouldn't have had that unrealized loss of an extra, $100. So again, this is why I'm advocating for early exit and just lock in your profits. Again, that's completely up to you. But overall, I like this website. I like the service. I like the developer. So the link is down in the description. The Twitter account of the developer is also down in the description if you want to give them a follow. So if you have any questions about my review of this website, go ahead and leave a comment, or you can ask me on Twitter at Trading5Talents. In the meantime, if you want to learn more about the wheel strategy and selling options in general, then click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely, take care.